Good afternoon, everybody, and thanks for staying back. I can't see anybody in the crowd. The lights are so bright, but I guess there's a few of you out there. I guess Sharanjit's done a great job of introducing this session, so I'm not going to take any more time away from the esteemed panelists that I have. But very quickly, my name is Arjun. I work with a consulting firm called Arthur D. Little, and I seems to be always on the stage with topics which are more utopian than I guess than the others which are packaged by Elevandi. So I don't know if Swapnendu has a cunning scheme out here putting me on these hard topics, but I've got a great panel here who are going to unravel the question. So would you all please just introduce yourself, because I wouldn't be able to do you guys justice.
I'm Rahul Banerjee. I am the co-founder and CEO of BondbloX. We are a bond exchange. We are a financial market infrastructure as an exchange based out of Singapore.
Hello, I'm Kuniko Ogawa, Managing Director for Equinix Japan, and we are delivering data center service. However, we are not just delivering data center service, we deliver interconnection service and a digital service. Now we are becoming the digital service provider.
Jason Beale, Head of Product with SBI Digital Asset Holdings. SBI being a large Japanese financial conglomerate, and Digital Asset Holdings very focused on the digital asset space within that group. Thank you.
I'm Douglas Feagin, President of Ant International. Ant International is the international subsidiary of the Ant Group in China. We're based in Singapore, and we're focused on cross-border payment, cross-border digital finance, and very pleased to be here at JFF.
Great. So welcome to all of you. Rahul, unfortunately, is sitting next to me, so you get the first question. Why don't we actually just deconstruct what does global financial infrastructure at its mean, and what's the significance of that in today's, I guess, commerce?
Sure. If we take the world of transportation, rails, aircraft, these are physical infrastructure. So FMI, or financial market infrastructure, is a very well defined term. And what it does is it covers the space of payments, clearing, custody, and ledgers, right? So, for example, when you do FX, you use financial market infrastructure. If you buy a stock on the New York Stock Exchange, that's financial market infrastructure. The participants are all exchanges, all payment providers, and they're always regulated. Some of the things about, and I'm talking at the moment about traditional financial market infrastructure, or FMI, is that they have to necessarily have a legal basis. They have to ensure fairness, transparency, lower costs, resilience, right? Compliance with laws. So that whole space is what is constitutes the financial market infrastructure place.
Right. So Rahul, Ogawa-san, I'll come to you, right? So Rahul's kind of painted a picture of what exists today, right? Would you share your views on some of the trends which are sort of shaping the future of this financial infrastructure?
Okay, so thank you for your question. So actually, we are, as Equinix, we are doing publishing some of the market study in terms of the, to take on the growth of the global digital economy, okay? And every year since 2017. And also, based on the latest our study, we are seeing the 90% of the Fortune 100, Fortune 500 company will become service provider by 2025. That's really interesting.
Yep.
So, and then based on that study, we are seeing three really important requirements through that. And the first one is a shift to subscription model. So this is not just for financial purpose. This is for the quick launch of the business everywhere you want, because digital business covers globally. So that's one thing. The second one is the quick catch up with the latest technology. So if you go with CapEx model, that's a really traditional model, it's really hard to move on to apply the latest technology because of the think of the ROI or something. So that's one thing. And then second one is the use of the ecosystem. So it's really hard to measure, how to utilize the ecosystem. But we as a platformer, we have the good measure to check on that. That is the growth of interconnection bandwidth. So we are seeing, based on our study, so CAGR 34% will be the growth of interconnection bandwidth for the next 5 years. And the last one is sorry, it's a little bit long. Sorry about that. So I like to...
You're going to help me ask the next question, so I'm going to pick one of those and ask.
Yeah, last one is really important, especially for financial customers. That's the proximity to data, okay? So this concept is not just for the location of the data. It's really important for proximity to having metro having very big population, and which means that having very big devices. So that generate a bigger number of data, right? So having the edge strategy to proximity to data is really important for financial customers.
Thank you. So, Jason, if you don't mind, I'm going to skip to Doug and then come back to you, right? So Doug, I'm going to pick on something. So Ravi Menon in his sort of keynote speech yesterday said one of the biggest challenges we in the financial services sector face is the clash between innovation and security, right? If I try and sort of wrap around the trends that have just been shared, right? Said, you're looking to digitize these technologies or advance these technologies of the financial infrastructure. How do you deliver this sort of, I guess, enhancement of growth, but at the same time, be cognizant of the concerns regarding security and privacy?
Sure. Well, thanks for that. And actually, drawing on your comments about the shift to focus on services and things like that for businesses, let me just pick the merchant sector because we provide payment from consumers to merchants. The merchant sector is actually transforming dramatically. And so take a typical merchant who's selling a certain product. They used to just sell their product, market it with a brand name. Increasingly today, though, they need to reach the consumer with a specific promotion, a coupon, get that into their hands quickly. And so they're looking to people like us to provide not only the payment infrastructure, but a marketing infrastructure on top of that. Very similarly, with small businesses, we have something called the D-Store, which enables them to have a kind of turnkey digital solution they can put in their store, and then therefore they can also reach the consumer. So it's a product seller becoming a service type company. But we believe when people have enablement with technology, they also need to have protection against fraud and against cybersecurity. To your question, exactly. And so we need to enable technologies to protect them. Everything from our Zolos KYC technology, which really uses biometric authentication for payment, to the kind of foundational level of security using data science to make sure transactions are real. So there's really, I think, a need when you invest in technology to invest in protection alongside that. And finally, I'd say you need to kind of just not stop at the infrastructure, but to look at innovation. And one of the things that we see happening now is privacy-protected computing, whereby consumers may not want to share their data with a third party. And privacy-protecting computing enables them to encrypt that and share the content of that data without the actual identification. And so these kind of things can protect at the same time as transact.
Doug, thanks. So, Jason, coming to you, right? So Rahul painted the picture of where we are today when we heard some sort of trends that picked up on the whole concept of innovation, which is one side of the equation. Can I ask you, what are the regulatory challenges with this sort of future global financial infrastructure? But it's a mouthful.
Yeah, I think when it comes to harmonization of infrastructure, especially going forward, there's a lot of challenges, not just regulatory, but interrelated with regulation. And I'd say there's sort of this triangulation of new technologies that are emerging. There's the evolution of the regulatory landscape and how regulation is changing and adapting to meet those new technologies. And additionally, how global standards and interoperability evolving to support that landscape. So if you take the technology, for instance, coming from a capital markets background, I can talk to those technologies at the moment being digital assets, blockchain, DLT, and artificial intelligence. And I think traditionally when you look at infrastructure and capital markets, technology in the past has really served to take existing processes and make them more efficient, enhance them. Whereas some of the technologies that we're talking about today have the potential to really disrupt the system. If you look at some of the concepts like peer-to-peer transactions, we have the ability to do away with intermediaries. If you look at shared ledgers, at the moment, traditionally, all participants in the ecosystem and all the layers of infrastructure within the ecosystem all have their own ledgers. And there's a lot of practices and processes that support that, reconciliations, checks and balances, that really underpin the infrastructure that we have today. So technology is really changing that landscape. And I think in this case, we could look at it as, transformational as opposed to incremental. So that's the technology piece. Regulation, I think with crypto, we've seen that there's a lot of reactive regulation in place. There's a lot of fast movement to accommodate dangers and to protect investors and to ensure that we have stability in the financial ecosystem. But we've also got this broader play on digital assets and the benefits that it can bring to the financial industry. So, there's this movement with crypto into what originally was anti-regulated, anti-centralization into the financial industry where it needs to adapt. And so through that, we've got, I guess, regulatory disparity between regions, because each of them have got their own focus areas. They've got their own adoption rates. And so we've got this mix of frameworks globally that we need to contend with. So that's the regulatory piece, and we need to sort of harmonize between regulators to bring that together. And then the third is standards. Okay, so there's a lot of fragmented innovation at the moment. There's a lot of debate around concepts like private versus public networks, the needs for sort of specific protocols that are going to service the financial industry. So this is an area that's still, there's a lot of moving parts to it. And we really need to bring the three of those together to provide this sort of a collective collaboration between private sector, public sector, and between regulators, in different regions to create this foundation for infrastructure to build on top of.
Listen, thanks. Rahul, I'm going to ask you, so Jason mentioned technologies, right? They said technologies are disruptive. Doug said that before that. Rahul obviously talked about industry. Can I ask you to take a deeper dive into blockchain, some of the other sort of innovations that are happening in technology space, and how does that actually play out from the context of the infrastructure?
Sure. Let's take what each one of us owns as financial assets, right? We own some cash, we own some stocks, some bonds, some mutual funds, etc. Now, you will at some point like to buy some more or sell, and that will need financial market infrastructure. So the entire system today is based on your bank knowing what you own, right? In the crypto world, we are going through Web3 and those topics. The most defining outlook of the future was described by the BIS chair, Dr. Augustine Karsten, on what he calls the unified programmable ledger, which is an infrastructure created by banks like MAS and the other banks, where you can plug in and you can say, I own this bond, I want to sell to, maybe Doug, and that transaction happens in that space. So that is the vision. Now, blockchain technologies or DLT is ultimately the L is the most important. There's a ledger, right? You can call it a shared ledger. Who should run the infrastructure? The ledger is the infrastructure. So if the ledger says Rahul Banerjee owns $3 worth of NVIDIA stock, then that has to be believed by everyone. So that's where blockchain really comes. Let me go back and tell you a little bit about why this is important. So today's securities ledgers run on what is called the Matryoshka style, the Russian doll style of ledgers, where the top ledger, a Euroclear or a Clearstream, sees only the 5 people below them. Those 5 see the 50 below. So you go layers, 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 and that's very inefficient. The other problem is, and I saw that in the panel on fintech and payments, is you need money faster. Vijay Shankar Sharma said, Japanese retailers want money with PayPay tomorrow, and that's what people want. So if you sell something or buy something, can you get that money instantly? And that's the second direction where we are going, where settlement times finally go down to 0 or atomic settlement. So those are the two things that the future looks like. And what the future will mean is efficiency. You can get a better price, whether you buy or sell. You can sell to anyone. You can get your cash really quickly. But that, my friend, is utopia.
Thank you. You said utopia, and guess what? He didn't use the word AI. So that allows me to plug AI, right? Although he did get a NVIDIA plugin these days, right? So,
what was $3?
Well, hey, $3 for some people, these days could mean a lot of money in how much the stock has done. Ogawa-san, coming back to you, I am going to ask you about AI, right? So we're infusing, I like that word, I think it brings memories of the kitchen, right? So we're infusing AI into everything, into financial services, into financial infrastructure, right? So are there any requirements? Right? Are there any qualifications to applying AI efficiently into financial infrastructure?
Okay, sure. So like you just mentioned, financial sectors are wondering how to harness the benefits from public cloud AI technology, right? And then also, on the other hand, everybody needs to, are kind of protecting very sensitive data, such as IP or something like that. So that is where AI comes into play with combined with the private AI and also the public AI running on the cloud. So you just already mentioned about that. So, and then also private AI is the exclusive use for AI. It's a really similar concept to private cloud, okay? And then private AI brings some of the benefits like lower the latency. This is really important for financial sector business. And lower the cost, which means egress cost using cloud. And also the lower the regulation risk as well in terms of the data regulatory. So, and then based on that, private AI is really important. And to enable private AI, data architecture is really important. So, and then data architecture have the 2 very important factors. One is the data custody, okay? If you are very good data custodian, you're free from audit and data recovery, and also the data, anything you want, right? So that's why, that's one thing. And then also another point is the data core concept, okay? Data core concept is not talking about just a specific location of the data. Data core concept is more like logical layer at the center of data architecture. So if we are, if you having the data custody and also data core, that brings, enable us to aggregate all the data into the data core from variety of edge sources. And you can easily move those data to, for example, upstream to a multi-cloud, and downstream to everywhere you want, like edge. Okay. So, for AI, data architecture is really important. However, as the baseline technology, if you do the business globally, the digital infrastructure is more and more distributed. So that's why baseline technology is a distributed digital infrastructure is a mandate, and also cloud technology is also mandate. That's why cloud adjacency trace is another point we need to think about. So data architecture and then more distributed digital infrastructure and cloud adjacency trace, those three are really important components. And lastly, those architecture needs to be interconnected all together. That is interconnection. So those 4 components is really a key success factor to enable AI.
Thank you. That was a masterclass answer. I hope somebody's taking notes because I'd like to borrow them after. Right. So, Doug, I think our panels call borderless, barrierless, something like that. So I'm going to go borderless with you. And then the funny thing here is, well, I don't know if it's a funny thing, but just what the point is, last year when I was at Kigali, we had a whole session around interoperability of cross-border payments, right? And how that would enhance greater connections, greater trade. We don't have a whole session, but I'm going to pose the same question to you, right? Which is, how do we enhance greater connection across cross-border and promote interoperability? And do you really think this whole interoperability stuff is mumbo-jumbo, or are we really going to actually achieve some sizable advances towards it?
Well, it's a fascinating question because interoperability, of course, sounds great to everybody, but it's very difficult to achieve. And so this is something, though, actually, what we see here in Asia is a marked desire on behalf of individual companies and private sector participants, as well as governments, to actually enable much more interoperability. And, we can see that in the payment infrastructure that we're living in every day. And so we see, for example, the emergence of e-wallets all around Asia as a new form of financial payment, financial inclusion, indeed serving many unbanked customers, underbanked customers. But those users of an e-wallet, when they want to transact like online or they want to travel abroad, historically they haven't been able to do that. And so, people are coming up with different innovations to make that happen. And so you can see, for example, national QR schemes in Southeast Asia, and the government's actually enabling connection between those national QR schemes where payment can happen. So at the top level, they're saying, we're going to mandate interoperability and make it happen. We at our company have a product called Alipay Plus, which is our solution to enable people to use their home e-wallet when they travel abroad or otherwise. And for example, here in Japan, we're enabling 16 e-wallets from all over Asia to come here and transact with merchants across Japan, millions of merchants. And they can just use their home e-wallet, open it up, pay. And so we do see kind of innovation of interoperability across these different regions. And I think that will dovetail with what I was talking about earlier in terms of the addition of marketing onto top of payments. So now, in addition to just being able to make a payment, the merchant can actually reach out, show a coupon to a customer or otherwise. So we see interoperability happening, and that's all within the kind of traditional infrastructure. As we add on new things, blockchain, other kind of solutions, we may even see greater interoperability as we go forward.
So Doug, here's my point, and I don't want to throw a dampener on this, right? So I'm a simple person. I look at a few interesting trends, right? So we're moving to a more sort of, if I may say, a multipolar nationalized agenda as far as payments is concerned. We're seeing proliferation of payment types that makes interoperability that much higher, that much harder. Yes, there is willingness of certain governments to cooperate with what they want to call friendly states and then otherwise. But what's most interesting is that the vast majority of, I guess, traditional businesses, which are behemoths, right, they're built around the concept of friction. Right? Friction is deeply embedded in their business model because that's how they make their money. So again, this is just pure statement. I've been watching this space over the last 10, 15 years as a payment practitioner. We've been talking about interoperability, even in the classical infrastructure. I don't know if we're going to move as quickly in the current environment. But let's come to a positive one. I've got a question for you, Jason. Right? SBI, DBS, and UPS, right? You guys recently collaborated and executed a cross-border sort of repo transaction, right? I think it's under the Project Guardian program, right? Can you walk us through the transaction and, how did sort of blockchain make it happen?
Yeah, maybe for context, I'll just, give a bit of insight into what Project Guardian is, which is a collaborative industry initiative sponsored by the MAS, Monetary Authority of Singapore. But it's a broad cross-section of industry and regulators. So as part of that industry working group, we've got the likes of, obviously, the MAS, but we've got the JFSA in Japan, the FINMA in Switzerland, also the FCA in the UK. And from industry, we've got 20-plus well-recognized regulated financial institutions as part of that industry working group. And the intention is to explore use cases for digital assets, blockchain, tokenization within the financial industry, and at the same time promote responsible use. Okay, and I'd say harmonization of both regulation and standards and best practices. These are all very high on the Guardian agenda. Okay, so the transaction that we did with DBS and with UBS was under the umbrella of Project Guardian. It was a live regulated transaction, so it wasn't a technical proof of concept. It was a real deal, and it was, as you mentioned, cross-border. It was a cross-border repo transaction across 3 jurisdictions. So UBS out of Switzerland, DBS out of Singapore, SBI out of Japan. Okay, and executed fully on the blockchain. Okay, on Ethereum public blockchain using smart contracts that were developed by the 3 parties involved. So a very bespoke ecosystem that was built on the blockchain in a public environment with what we called a permissioned overlay to keep it secure. Okay, so the transaction that we executed, UBS issued a native digital bond, which means there's no off-chain representation of that bond. Okay, but the token for that bond that's on-chain is the legal representation for that bond. That was purchased by DBS in Singapore, and to finance the purchasing of that bond, they entered a repurchase agreement with SBI out of Japan. Now, the form of the funding that SBI provided to DBS was in the form of stablecoins issued out of Japan by SBI. So what we've got here is this sort of like multi-leg transaction, and there's 2 steps to it. There's an opening leg and a closing leg. Okay, the initial day 1 leg is the purchase of the bond and the securing of finance to do that purchase. The bond is passed to SBI as collateral for the loan. So it's effectively a collateralized loan and a bond purchase wrapped into one across 3 different jurisdictions. Then 1 week later, we've got the maturity of that bond. It's very short dated, and it's coupled together with the closure of the repo for proof of concept reasons. We've done that alignment deliberately. The maturity payment on the bond by UBS, again, as a digital payment token. This time, not a stable coin, but a tokenized deposit issued by UBS out of Switzerland. That payment goes across to DBS for the bond, but flows straight across to SBI as a repayment on the loan, releases the collateral, and the bond is matured. Okay, so we've got this very complex deal structure. Now what I'll do is I'll talk to the benefits of blockchain, what it meant for the transaction. Okay, I think the first key concept is atomic transaction. Okay, and we've got what traditionally would be a number of different sequential legs to a transaction, that would require intermediaries. Okay, so we've essentially got 2 DBP transactions up front, and with the blockchain, we're able to combine that into one atomic transaction, exchange of digital currencies for bonds across 3 different jurisdictions in one hit, okay, without an intermediary. So that's very significant. Okay, the second is, well, actually, I already mentioned it, is the no intermediaries, okay? So not only have we got that atomic DVP and the reduction of credit and settlement risk across 3 parties and 3 jurisdictions, we don't need an intermediary for it, okay, a trusted third party. The third is we've got immediate settlement, okay? So this activity that we did on the blockchain, being a proof of concept, is highly orchestrated. So we had a very, like a structured, regimented process to follow, which took us about, I'd say for each leg, to run through it, do all the checks and balances as an exercise, took about 1 hour. But had that been sort of an organic sort of flowing transaction, it may have taken 5-10 minutes, okay? So it was almost immediate when we executed, okay? And that's settlement at trade happening there. The fourth is automation, okay? So we've got these smart contracts with very complex behavior embedded into them to orchestrate all the movement of assets and deal with all the, I guess, you know, we didn't encounter it in the transaction, but all of the unhappy scenarios. What if somebody doesn't pay the right amount? What if they overpay? What if the bond matures before the payment is received, etc.? Okay, so there's a lot of complexity embedded into the smart contracts, and they orchestrate everything from order management, execution of the trade life cycle, the movement of the assets to the right parties, the distribution of payments, etc. So there's a lot of complexity there embedded in smart contracts, and it's all automated. Okay, and the last is asset servicing. So one of the things that we were able to prove with this transaction was the distribution of payments on the blockchain belonging to the asset. So we've got corporate actions being executed on the blockchain in a way that the lifecycle management is simplified because the payment just gets distributed directly to the recipient and the holder of the bond. So there's some of the benefits that we saw with this transaction.
Thank you, Jason. Okay. Ladies and gentlemen, we have 3 minutes, so I'm actually going to give you all a minute each, or a little less than a minute, for your closing thoughts. Rahul, we can start with you.
Oh, sure. I think the transaction Jason just described is the holy grail. Now, as closing thoughts, I'll just ask a question to the audience, right? And around bonds, right? So the Fed is paying for really short tenor bonds 5.3%, right? All of you have money, and all of you will not use all your money tonight. All of you would love to have that 5.3%. And that's the problem with the classical financial market infrastructure, that you cannot instruct yourself to invest that money overnight at 5.3% and have it available for reuse tomorrow morning, right? So that is the infrastructure that we need. And what we've seen is that the crypto world did lots of parts of it, but there were other issues. And what companies and Project Guardian's doing, or what BondbloX is doing, right? You can actually use that global new payment rails. So you can go on board with BondbloX and go and buy those bonds. So to me, this space will change. The last time it changed was 1988 when ICSDs came. So after another 40 years, which is now, it'll change, and very soon it'll become as easy as using a QR code, right? By the time we have the next FinTech festival in Japan, I'm sure it would be much more progress.
San, you, and then Doug, if you don't mind, last words from you. Right. So Ogawa-san, first you.
Me?
Any closing thoughts?
Oh, okay. So I'm talking about a little bit about sustainability.
Sure.
So if the business will going for digital, that means more power, increase of power is really important. So as the data center service vendors, we need to prioritize sustainability. And then we established R&D Center for Future Sustainable Data Center in U.S. Ashburn. And there's 4 pillars we are focusing on. One is the use of the low carbon energy. Okay. Second one is the innovation of cooling. That's really important. And the third one is the kind of the circular economy, which is the life cycle management of the water and the heat. Okay. And the last one is to implement AI into a data center operation. So, and I would like to say about cooling technology. So currently, air cooling is the kind of common. However, applying AI will accelerate the power consumption, right? So that's why we are focusing on liquid cooling solution. Then we decided to deploy liquid cooling solution into the 45 metro globally. So that's why our platform is really best fit for AI.
Good luck. Think so.
Oh, so I just to speak a little bit more broadly in terms of the importance of financial infrastructure and the focus on serving the underserved. I think that financial inclusion is still vastly needed in the world today. There were 2.2 billion people that had no access to financial services over 5 years ago. That number's been reduced to 1.8 billion today. And we can see many players using innovation in terms of digital payment, digital savings, and then digital accounts for merchants like SMEs who want to reach the world. And so I think a lot of this digital infrastructure can actually enable a much better world for all of us. And that's an interesting overlay to some of the more technical aspects that we're talked about here that really are quite revolutionary. We hope we can include that as well.
Excellent. We are ending with fintech saving the world. So, we couldn't have ended the session any better. So I'd like to thank everybody, Doug, Jason, Ogawa-san, Rahul. Thank you for your time. Thank you for your candor. I hope you all took your notes. It was a bit of a masterclass. I hope somebody was recording it because I want to take this home. But with that, thank you for your patience. Goodbye.
Thank you.